and today we're going to be talking about the 5 worst investing mistakes that I'm seeing investors make right now in 2025, particularly with this recent stock market turbulence, all this volatility. It can be a little bit of a tricky time to invest. So let's talk about some common traps that people fall into in these periods and how you can work around these problems to give yourself the best possible chance at having really great returns. And that's what we're all about.
Investing is supposed to be a smart way to grow wealth, but even the most seasoned investors aren't immune to mistakes. Experience helps, but it doesn't eliminate human psychology, market volatility, or the influence of misleading information. The truth is, many experienced investors make errors that cost them millions over time. And the most dangerous part is that these mistakes often go unnoticed until it's too late. Today, we're going to uncover the most common investment mistakes even the pros make, and more importantly, how to avoid them to protect and grow your wealth. The first mistake is letting emotions drive decisions. Even experienced investors can fall victim to fear and greed. Fear often causes panic selling during market downturns, while greed leads to chasing high returns without understanding the risks. Market volatility triggers emotional responses that override rational planning, leading to losses that could have been avoided. Successful investing requires discipline and a steady mindset, not reacting to headlines or sudden market swings. Recognizing when emotions are influencing decisions is critical to avoiding costly mistakes. Overconfidence is another silent killer. Experience breeds confidence, but too much confidence can blind investors to risk experience. Investors may assume they can predict markets or spot trends that others cannot. This often leads to overexposure in a single stock, sector, or asset class. Even professionals fall prey to the illusion of control, forgetting that no one can consistently predict market movements. Diversification and humility are key to preventing overconfidence from eroding wealth. Failing to rebalance portfolios is a mistake even seasoned investors make. Over time, some investments outperform others, shifting the intended allocation. Without rebalancing, portfolios may become too heavily weighted in high-risk assets or underexposed to safer options. Rebalancing restores the original risk profile, helping investors stay aligned with long-term goals. Skipping this step can unintentionally increase risk and reduce return, even for those who think they have everything under control. Ignoring fees and hidden costs is another common error. Many investors focus solely on returns while overlooking management fees, transaction costs, and hidden expenses. Over time, these fees compound, significantly reducing net returns. Even experienced investors underestimate how much small fees can erode wealth, especially in actively managed funds or frequent trading strategies. Understanding the cost structure of investments is crucial to maximizing returns. Chasing performance instead of strategy is a recurring mistake. Investors often buy assets simply because they have performed well recently, assuming the trend will continue. This herd mentality can lead to buying at the peak and selling during a decline. Experienced investors are not immune to this trap. They may overanalyze short-term performance while neglecting long-term fundamentals. Following a disciplined strategy rather than chasing returns is essential to avoid unnecessary losses. Neglecting tax implications is another costly oversight. Experienced investors sometimes focus on pre-tax returns without considering how capital gains, dividends, and interest will be taxed. Poor tax planning can transform a profitable investment into a marginal one. Strategic use of tax-advantaged accounts, loss harvesting, and timing of transactions can preserve wealth and enhance net returns. Ignoring taxes is a mistake that even seasoned professionals occasionally make. Overcomplicating investment strategies is surprisingly common. Experienced investors may try to maximize returns by layering complex strategies, derivatives, or exotic instruments. While these can work, complexity increases the chance of mistakes, misunderstanding, or unforeseen risk. Sometimes the simplest strategy is diversification, low-cost index funds, and disciplined investing outperform overcomplicated approaches. Complexity should enhance strategy, not create vulnerability. Ignoring liquidity needs is another hidden mistake. Investors may tie up money in long-term or illiquid assets without considering potential short-term needs. In emergencies or market downturns, this can force selling at a loss. Even experienced investors sometimes underestimate the importance of liquidity, assuming assets can always be converted to cash easily. Balancing growth with accessibility is critical to protecting your financial position. Failing to adapt to changing market conditions can also be a problem. Experienced investors often rely on past knowledge, assuming that what worked before will continue to work. Markets evolve, regulations change, and economic conditions shift. Sticking rigidly to old strategies without reassessing risk, diversification, or asset allocation can lead to underperformance. Continual learning and flexibility are essential to remain successful over time. Overconcentration in familiar industries is a subtle mistake. Investors often gravitate toward industries they know, assuming expertise will yield higher returns. While familiarity can help, it may also blind investors to risks or prevent exposure to high-performing sectors outside their comfort zone. Diversifying across sectors, industries, and geographies reduces the risk of unexpected downturns impacting the entire portfolio. Neglecting alternative assets is another common error. Experienced investors sometimes focus exclusively on stocks and bonds, ignoring other asset classes like real estate, commodities, or private equity. Alternative investments can provide diversification, reduce correlation risk, and offer protection during market turbulence. Ignoring these opportunities limits growth potential and leaves portfolios exposed to traditional market cycles. Underestimating inflation is a mistake even seasoned investors make. Holding too much cash or low yield investments during periods of rising inflation erodes purchasing power. Inflation may be slow-moving, but over years, it silently reduces wealth. Experienced investors sometimes focus on short-term returns while overlooking long-term impact, forgetting that inflation can silently undermine even seemingly profitable investment. Timing the market is an almost universal temptation. Even seasoned investors try to buy low and sell high, believing they can anticipate trends. The reality is that timing the market consistently is nearly impossible. Even experts make mistakes here, losing money when they misjudge entry or exit points. A disciplined, long-term approach to investing often outperforms attempts at timing, preserving capital while compounding wealth steadily. Failing to monitor behavioral biases is another subtle but costly mistake. Experienced investors are not immune to cognitive biases like confirmation bias, loss aversion, or recency bias. These biases influence decisions unconsciously, leading to overtrading, poor diversification, or chasing trends. Awareness of these biases and implementing checks such as automated investment plans can reduce errors caused by human psychology. Overlooking global diversification is another pitfall. Many experienced investors focus primarily on domestic markets, assuming they are sufficient for growth and security. However, global diversification reduces risk by spreading exposure across different economies and currencies. Ignoring this can leave portfolios vulnerable to regional downturns or political and economic instability. Smart investors incorporate international assets to balance growth potential with protection. Failing to review goals regularly is surprisingly common. Experienced investors sometimes become attached to legacy strategies, forgetting to adjust their portfolios as life circumstances, risk tolerance, or financial goals change. Retirement plans, family needs, and lifestyle changes all require periodic reassessment. Ignoring goal alignment can result in portfolios that are either too risky or insufficiently aggressive to meet objectives. Ignoring cash flow management can quietly sabotage investment success. Even successful investors sometimes overlook the importance of maintaining sufficient cash flow to fund investments or cover emergencies. Without proper cash flow, opportunities may be missed, and short-term pressures can force premature selling of assets at a loss. Balancing growth with liquidity and cash management ensures both flexibility and stability. Relying too heavily on past performance is a trap many seasoned investors fall into. Just because an asset performed well in the past doesn't guarantee future returns. Experienced investors sometimes assume patterns will repeat, ignoring shifts in market fundamentals or macroeconomic conditions. Diversifying and constantly evaluating risk helps avoid losses stemming from overconfidence in historical trends. Ignoring the cost of leverage is another mistake. Borrowing to invest can amplify returns, but it also magnifies losses. Even experienced investors sometimes underestimate how leverage interacts with market volatility, interest rates, or unexpected downturns. Using leverage without a clear strategy, risk management, and contingency planning can turn profitable investments into financial disasters. Failure to consult multiple perspectives is subtle but costly. Experienced investors often rely heavily on their own research or trusted advisors. However, markets are complex, and a single viewpoint can overlook emerging risks or opportunities. Seeking multiple perspectives, professional advice, or independent analysis reduces blind spots and prevents mistakes rooted in limited insight. The key takeaway is this: experience helps, but it doesn't guarantee immunity. Markets are unpredictable, human psychology is fallible, and strategies that worked in the past may fail under new conditions. By maintaining discipline, continuously educating yourself, diversifying strategically, and periodically reviewing goals, even seasoned investors can avoid costly mistakes and thrive over the long term. Investing is not about being perfect, it's about being vigilant adaptable, and disciplined. Mistakes are inevitable, but minimizing their impact separates successful investors from those who struggle. Awareness, strategy, and consistent execution are your greatest allies in navigating financial markets safely and effectively.